If you want to rent an apartment, buy a car, or even get a decent phone plan, a stranger is going to run a background check on your financial soul. They call this check your credit score, and it is easily one of the strangest inventions of modern society. We live in a world where your worth as a borrower is boiled down to a single three-digit number between 300 and 850. If that number is high, the red carpet rolls out and banks practically beg you to take their money. If that number is low, you get treated like a financial drifter who cannot be trusted with a single dollar. The wildest part of this entire system is that we all just accepted it as normal. Think about the last time you bought groceries or paid your electric bill. You probably did not think about how a private corporation was watching that transaction, taking notes and grading your performance. But they were, and they do it every single day. Understanding this system matters because it is the ultimate gatekeeper to the things you actually want in life. It determines whether you get to buy a home of your own or remain trapped paying off someone else's mortgage forever. It even affects how much you pay for basic necessities like car insurance. So, how did we end up letting a group of private companies decide who gets to participate in the modern economy? To understand that, we have to look at how we used to measure trust before computers took over. In the old days, credit was not a math problem. It was a human relationship based on whether the local shopkeeper knew your face and your family. If you were short on cash, the baker would write your name in a paper ledger, trusting you would pay when the harvest came in. This was a simple system of local trust, but it had one massive flaw. If you moved to a new town, your reputation stayed behind, and you had to start from absolute zero. As the world got bigger and people started moving to cities, that personal trust fell apart. Businesses needed a way to figure out if a stranger was going to pay them back. This brings us to the birth of the modern credit industry, which started out much weirder than you might think. In the late 19th century, early credit reporting agencies started popping up. These were not the high-tech firms we know today. They were literally rooms full of people writing down local gossip. If a merchant wanted to know if you were reliable, they would pay a service to look you up in a giant book. These books did not just track your debts, they tracked your personal life, your drinking habits, and even your reputation in the neighborhood. If someone didn't like the look of you, or if you had a public argument with a shopkeeper, that could end up in your permanent file. It was a deeply biased system that depended entirely on rumors and subjective opinions. Fortunately, the system eventually changed, but not necessarily because people wanted to be fair. It changed because businesses realized they were losing money by relying on bad gossip instead of real data. In the late 20th century, a company called Fair Isaac Corporation decided to turn credit into a mathematical formula. This formula became known as the FICO score, which is the standard system most lenders still use today. On paper, this looked like a massive improvement because it stripped away the personal biases of local lenders. It didn't care about your background, what you looked like, or what your neighbors thought of you. It only cared about your cold, hard financial history. But in reality, this created a brand new set of rules that we all have to play by, whether we like it or not. The biggest irony of the modern credit score is that to get a good score, you have to prove you don't actually need the money. If you have a massive pile of cash in your bank account but have never borrowed a single dollar, your credit score is non-existent. To the algorithm, a wealthy person with no debt looks exactly like a ghost. You are completely invisible to the financial system. To build a reputation of trust, you have to actively borrow money and pay it back over and over again. It is a bit like trying to get an entry-level job that requires 5 years of work experience. You can't get credit without a history, but you can't build a history without credit. So, how does this algorithm actually decide if you are a safe bet or a financial risk? The math behind your score is kept secret, but we know the main ingredients that go into the blender. The single most important factor is your payment history, which makes up more than 1/3 of your total score. This is simply a record of whether you pay your bills on time. If you miss a single payment by more than 30 days, your score can take a massive hit that takes months to recover from. The system has a very long memory, and it doesn't care if you had a really good excuse for being late. The next big factor is something called credit utilization. This is a fancy term for how much of your available limit you are actually using. Imagine a bank gives you a credit card with a limit of $10,000. If you immediately go out and spend $9,000, the algorithm starts to panic. Even if you plan to pay it all off at the end of the month, using that much of your limit makes you look desperate for cash. Lenders prefer to see you use less than 30% of your available limit. It's like having a friend who keeps borrowing your car, but only drives it around the block. You're fine with it because they don't push the vehicle to its absolute limit. But if they start taking your car on cross-country road trips every weekend, you might start worrying about when it's going to break down. The third ingredient is the age of your credit history. The longer you have active accounts, the more predictable you are to the computer. This is why closing an old credit card you don't use can actually lower your score. You might think you are being responsible by cleaning up your accounts, but you're actually cutting off your own history. The system rewards loyalty and longevity, even if it's with a card you keep buried in a drawer. Finally, the algorithm looks at the types of credit you have and how often you apply for new loans. If you suddenly apply for 5 new credit cards in a single week, the system flags you as a high risk.
To the computer, it looks like you are preparing for a massive spending spree before disappearing off the grid. Every time a lender checks your score for a new loan, it leaves a tiny mark called a hard inquiry that lowers your score temporarily. It is a fragile balance where almost any active attempt to improve your situation can look like panic to the algorithm. Now that we know how the system is built, we have to talk about the companies that run it. Credit bureaus are not government agencies. They are private, publicly traded corporations whose main goal is to make money for their shareholders. They don't work for you. You are actually the product. Your financial habits are packaged, analyzed, and sold to banks and insurance companies. This brings us to the credit card companies themselves, who have built one of the most profitable business models in human history. Have you ever wondered why credit cards offer points, cashback, and free flights just for using them? It seems like free money, but as you can probably guess, there is no such thing. Credit card companies make their money in two main ways. First, they charge merchants a small fee of around 2 or 3% every time you swipe your card. This is why some small businesses have signs asking you to pay cash for small purchases. But the real cash cow for these companies is interest. When you carry a balance from month to month, you are charged an annual interest rate that is often over 20%. To put that in perspective, if you borrow $1,000 at a 20% interest rate, you will owe an extra $200 by the end of the year just for the privilege of holding that debt. The system is designed to keep you in a state of perpetual borrowing. If you look at your monthly statement, you'll see a small number labeled minimum payment. This is often just a tiny fraction of your total balance, usually around $25 or $30. It's incredibly tempting to just pay that small amount and forget about the rest. But if you only pay the minimum, it can take you decades to pay off a simple purchase. The companies don't want you to fail completely and default on your debt, because then they lose their money. But they also don't want you to pay everything off instantly, because then they don't make any interest. The sweet spot for them is a customer who is constantly carrying a balance, paying interest month after month, but never quite drowning. They want you on the financial treadmill, running as hard as you can but never actually getting anywhere. It's very easy to look at this system and feel completely overwhelmed or angry. It feels like a rigged game where the rules are written by the house. But the good news is that once you understand the rules, you can use them to your advantage. You don't have to fall into the debt trap to build a good credit score. The simplest strategy is to treat your credit card exactly like a debit card. Never spend money on a credit card that you don't already have in your bank account. Set up automatic payments to pay off the entire statement balance every single month. This allows you to build a perfect payment history without ever paying a single dollar of interest. You get all the benefits of the credit score, plus the points and protection, while the card company gets absolutely nothing from you in interest. It's the ultimate way to beat them at their own game. Another simple trick is to keep your oldest account open, even if you don't use it anymore. Put a small recurring subscription on it, like a $5 streaming service, and set it to autopay. This keeps the account active and preserves your long history without any effort on your part. Remember that credit is not wealth, it is just a tool. Having a high credit score does not mean you are rich, it just means you are good at managing debt. True financial security comes from your savings, your investments, and your cash flow. Don't let the pursuit of a perfect 3-digit number cause you to make bad financial decisions. Use the system to get the house or the car you need, but don't let the system use you. Hopefully this makes the strange world of credit feel a little bit more manageable. If you found this helpful, feel free to subscribe for more real conversations about money. Just remember that I am a guy on the internet, not your financial advisor, so always do your own research before making big financial moves. Thanks for hanging out, and I'll see you in the next one.